If you've been waiting for the Texas real estate market to crash, you can stop holding your breath. The speculative frenzy is over, and the market is cooling down into a much more normal state. Statewide inventory is steadily rising. Homes that used to vanish in a weekend are now sitting on the market for an average of 72 days. You'll see list prices dropping across major cities, creating the impression of a massive buying opportunity. But that creates a serious dilemma for buyers in 2026. Does snagging a discount on the initial sticker price actually guarantee lower monthly expenses? The short answer is no. Trusting a discounted list price is a financial trap because it ignores the day-to-day operational reality. To understand why, you have to look closely at what we call unmortgaged carrying costs. These are the mandatory expenses you pay outside of your principal and interest. In Texas, they come down to three main pillars: property taxes, homeowners insurance, and mandatory HOA fees. This chart shows the divergence. The Texas median home price line flattens into 2026. Below it, an expanding wedge of taxes, insurance, and HOA fees grows aggressively. This wedge swallows your mortgage savings. The total monthly payment gets pushed higher, even on a cheaper house. Success in this market requires abandoning acquisition price optimization and running a strict audit of your total monthly carrying costs. Those costs look very different depending on where you look. Texas is massive, and regional differences create drastically different financial profiles. Take Austin. Prices there have dropped 3.6% year over year, which affords buyers a significant amount of leverage at the negotiating table. The trade-off is that while entry prices are lower, Austin property owners still face severe weather exposure and inflated property tax baselines held over from the peak boom years. Up in Dallas, you'll find a sharper 4.1% correction. Builders aggressively constructed new homes there during the pandemic, leading to localized oversupply. Houston is the outlier. It offers relative stability, showing a modest 3.2% price growth with a highly accessible median price around $324,000. The lower price tag makes it much easier to qualify for a loan initially, but you trade that accessibility for high vulnerability to Gulf Coast insurance volatility. Your choice of city mathematically locks you into a specific type of unmortgaged financial risk. To capture entry-level buyers, builders are actively pivoting towards sub-$300,000 new construction. These builds offer immediate benefits. They provide turnkey living, lower upfront maintenance, and builders frequently offer right buydowns to lower your initial monthly payment. But to build at that price, developers push these communities deep into the outer ring suburbs. That exposes you to mandatory HOAs and specialized utility district taxes to pay for new infrastructure. Nationally, the prevalence of HOAs is nearing 44%, and the median cost of those monthly dues is steadily rising. An affordable new build often functions as a Trojan horse, attaching a permanent, uncontrollable monthly HOA liability directly to your budget. Then you have to factor in insurance. Statewide, homeowners insurance premiums are projected to jump 8% in 2026. To keep coverage affordable, homeowners are resorting to defensive tactics, like investing in smart home leak sensors for a discount, or accepting high deductibles to lower the monthly rate. Beyond insurance, rising municipal tax assessments pose the single most volatile threat to a Texas homeowner's monthly budget. The homestead exemption is your ultimate defensive tool. If you live in the home, this $140,000 exemption slashes your taxable value, leaving a much smaller net tax bill. Out-of-state investors don't qualify. Without it, that gross tax bill crashes down with full, unmitigated weight. Landlords are left paying peak state tax assessments, which destroys the cash flow margins on their rental properties. The Texas tax code mathematically punishes absentee landlords while providing vital financial life support to resident homeowners. This decision tree tracks your 2026 options, starting with the split between a primary residence and an investment. For a primary residence, target outer suburb new builds for builder incentives, but you must file annual tax protests to prevent assessments from pricing you out. If you are an out-of-state relocator planning to buy the dip in Austin, expect flat equity growth. You need to plan on a minimum 5 to 7 year hold to ride out the market correction. For investors, leverage the state's 1.1% job growth for tenant stability, but you have to negotiate the initial list price to offset the lack of tax exemptions and the rising insurance rates. The strong macroeconomic fundamentals in Texas, specifically energy, finance, and construction, mean the market remains highly viable despite the rising carrying costs. Texas is no longer a guaranteed gold rush. Success now requires a clinical audit of your carrying costs rather than a celebration of a discounted list.